In short, this rotation ends when the economy hits a wall and long-term interest rates stop going higher, or at least take a breather, which could give you a chance, if you get one tomorrow, to do a little selling, because the 2015-2016 scenario that I keep talking about will take a little time to play out. Why? Because the Fed this time has been adamant that it won't be raising short-term rates anytime soon. That takes away from that Janet Yellen raise, although, of course, people feel Jay Powell will capitulate when we get the big stimulus and we get the reopening. Now, once we get a cathartic collapse of epic proportions, as some people think we will have it in a single day, that's what we call a whoosh down, instead of this drip, drip, drip. Then you can swap back from the boom and bust stocks to the consistent growers. Let me put it like this. We've never really seen a run like this in travel and leisure or the industrials, particularly travel and leisure, because we've never, of course, been closed down for a full year. But we've absolutely seen sell-offs like this in the high multiple tech stocks quite often. And they tend not to crescendo to a bottom until we have rate hikes, a slowing economy, and some high-profile blow-ups. None of these is likely anytime soon, though, although you can certainly expect some bounces along the way, as rates never go up in a straight line. These companies are doing so well that there will come a time when the selling abates a bit and you get a knee-jerk rebound, as you did several times in late 2015. And before the big whoosh down that you got in February, there were many times to sell. Maybe you avail yourself of them. Do you sell all the things tech and swap into planes, trains, automobiles, industrials? Not to mention the newly red-hot oils. You know I like Chevron and Pioneer every night. They're the only two I'm willing to recommend. Frankly, if you're nimble enough, that's okay. I'm game. You're up a lot. We've been scaling back on the tech names from our charitable trust for weeks now, replacing them with industrials, because that's what you do at this point of the cycle. But if you can't be nimble, if you're not confident you can swap back into tech at some lower level that's close to the bottom, then don't try to dump your whole position. Scale back on your favorite tech stocks so you can buy more at lower levels. You'll have room. And this is something I'm going to be telling people in my ActionAlertsPlus.com club call tomorrow at 11:30. Scale back. You'll have room. Bottom line. I know it's tough to just stand there and take punches. Isn't it awful? I think these well-run companies that have thrived during the pandemic, they always come back. But their stocks won't start rebounding until the Fed tightens or the economy slows for some other reason. And that could be a long way away if the economy reopens on schedule and we get a stimulus package. Of course, you know what we have to hear. We have to hear fang dead, fang dead, fang dead. And, of course, and what really has to happen? Well, Apple. In the meantime, we've got a glut of tech stocks and a shortage of cyclicals. Right now, you got to go with the shortage.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.